Hello, hello. Okay, so continuing on the different types of entity segment, today I wanted to talk about S corporations. Um, I actually have quite a few videos about S corporations, and it has a lot to do with the fact that they are one of the best ways uh, for the sweet spot to report your taxes. Um, Now, the biggest confusion I find with S corporations is that people think it is a legal entity. It is not. An S corporation is a way we pay taxes. Um, so either your entity is legally registered with your state as a corporation or a limited liability company. And then there are mechanisms in place to elect with the IRS to have or to file your taxes or report your taxes as what is called a subchapter S corporation of the Internal Revenue Code. So the biggest thing is it does not change the type of entity you are. I find that's quite confusing to people because you think your business is an S corporation. It is an LLC taxed as an S corporation, or it is a corporation taxed as an S corporation. So anytime you're filling out like legal documents for banks or for loans or credit cards or like with local government, you're always going to mark that it's either a corporation or a limited liability company, unless the question is specifically asking for tax purposes. For example, if you're filling out a W-9 as a contractor, uh, or you're providing service to another company and you're filling out a W-9 for them, you would mark that you are an LLC taxed as an S corporation, or you mark it as a corporation being taxed as an S corporation. Um, so what is the benefit to being an S corporation? Like I said, it's kind of the sweet spot. It is really what unless you have a specific reason why you need to be a full C corporation for tax purposes, most of the time you want to pass your non-personal revenue through an S corporation. And what do I mean by that? So like personal income would be like W-2 wages. You are personally working to earn the money, so it's going to go through you personally instead of it being some sort of business revenue, trade or business revenue. So any trade or business revenue you want to pass through an S corporation, and that is because it's not necessarily a tax shelter in terms of what are a defined tax shelter, but in layman's terms, it's a tax shelter for Medicare and Social Security tax, or it can be if structured correctly. Um, So if you earn $100,000 as a sole proprietorship, you're going to owe self-employment tax on that. Uh, the rate is 15.3%, so you're going to owe about $15,300 back of the napkin in self-employment tax. Now, there are some other calculations in there. There's some exemptions and a few things, so it's not quite $15,000. It's more like $14,500. So it's just really close. That's what you're going to owe instantly in self-employment tax, and then you're going to run the $100,000 through your regular income tax calculations. So you say, "Well, wait a minute. I'm going to elect to be taxed as an S corporation." And the idea there is that when you become a corporation, you are going to get some of your profit in the form of dividend distributions and some of it in the form of W-2 wages. You become a shareholder of your company, which is called passive income, investment income, not subject to Medicare and Social Security tax, usually. There are exceptions. And then you're going to be an employee of your company, the CEO, who is required to receive reasonable and fair wages, ran through a W-2. So you are the president of the board of directors, and you are the CEO if you want to have official titles. Um, why would you elect that over a regular corporation? Regular corporations just for we'll get more into detail on it, but ultimately all your cash is locked in a regular corporation unless you're willing to pay double taxation on it. We'll get into more details about that when we talk about corporations. There are benefits to a corporation and there are downsides to a corporation. A lot of those downsides get corrected in an S corporation. A lot of the downsides to being a sole proprietorship or an LLC, taxed as a disregarded entity, a lot of those downsides get corrected and become benefits in an S corporation. An S corporation can also take a single member LLC that's taxed as a sole proprietorship. A sole proprietorship is kind of an informal business. And so you give it an LLC and you kind of create some formality around it. But if you're still paying taxes as a disregarded entity, there's not as much formality around it. And so if you make the election to treat your LLC as an S corporation, you are now creating more formality around it. You're setting it apart from you legally and for taxes, which allows you to kind of take additional interpretation and stances on what are business expenses, what are ordinary and necessary business expenses. For example, not all states require this, but some states do require that you take a shareholders retreat every year to address the goals and financials of the corporation. Well, an LLC can't take a shareholders retreat because it's not a corporation. But if you move into the corporate realm, now technically, if it's part of the state law, you are required to take a shareholders retreat every year. So there's just different ways that you can justify other things. But that is a sword that, that's a double-edged sword that can cut both ways. So, for example, income that might be considered personal under a sole proprietorship could end up potentially becoming taxable under an S corporation. There's everybody has a unique situation. There's different things that can happen there. But because it's a standalone entity, it can have different problems. One of those things being real estate. So this is a downside on any corporation, whether it's a C corporation or a normal corporation or an S corporation, is the ownership of real estate. So typically, you don't want a corporation owning real estate. You don't want real estate in an operating company. For two reasons. One, you don't want to combine the risk. I'm not an attorney, so I'm not going to get into a lot of details about that. But if something negative were to happen to your operating company, you get a lawsuit for whatever reason, the risk or that lawsuit can translate into combining that risk with your real estate, separating it out into a separate LLC, or even to just you personally outside of your LLC or corporation, can limit that risk on the real estate itself versus the actual operating company. So you want to try to keep risk associated with any activity contained within that activity. You don't want it to spread out into other investments or activities. And so that could actually be argued any investments. So like stock portfolios or bonds or savings accounts or anything like that should actually be housed outside of your operating company. Another downside, though, to having real estate in a corporation is you have what is called a deemed sell. So if you have real estate inside a corporation, S corporation or C corporation, and you distribute that out for whatever reason to yourself. So even if you're the 100% shareholder in your corporation, you are the 100% owner in the real estate. Uh, if you were to take that real estate out of your corporation and put it into something else, let's say, for example, you decided you had a an office building that you were using for your corporation, and then all of a sudden you move, you're growing, you outgrow it, so you move, and so you don't want to claim that office building as part of the corporation anymore. So let's say you pull it out to put it into a rental holding company. Well, when you pull that out, even though you aren't actually selling it, so there's no cash exchanging hands, you have a deemed sell. The corporation just sold you personally this apartment or this office building. And so you have to calculate the fair market value of the office building and report that taxable gain on your corporation, which is a pass through entity. So ultimately, you are now paying taxes on the fair market value that you pulled out of this corporation on this rental property when you didn't actually receive cash because you sold it to yourself. So there are some very negative consequences to having real estate in a corporation. So, just a quick summary, an S corporation, in my opinion, is the sweet spot for any trade or business to pass through at some point. You would own, personally, I would say that you should have any business, whether an LLC or a regular corporation or a partnership, should be passing through as an S corporation unless you have specific reasons why not. That could be financial restraints. That could be outside investors, that could be third parties. But typically, if you're a single member LLC or if you are in a partnership, your partnership share, which we'll talk about next week, should pass through the S corporation, or your single member LLC should elect to be taxed as an S corporation because you will minimize that self employment tax. There are some downsides to being an S corporation. It creates formality around this entity that now needs to act like a corporation. There's going to be administrative costs to that, and such as bookkeeping, increased tax preparation fees, different reporting requirements, and the biggest downside is now your S corporation cannot hold real estate versus a regular LLC that could. Anyway, that's kind of my quick summary of an S corporation. Hope it is beneficial to help you understand as you decide which type of entity to pick as you're forming your business. Have a great weekend. See you next week.